Yes. So, but you don't want a one-word answer for this. Um, yes, definitely the euro crisis would affect Chinese trade because a lot of their trade goes to China. And you can see a situation where if Europe goes into a deep depression, that that trade is going to get hammered. And if Europe goes into a deep recession, that will negatively affect other parts of the world too, will affect the US in particular, which again is going to have a negative effect on Chinese trade. So basically, we, we cannot expect to see China growing at 9% a year forever. It's just not going to happen. So those growth rates will decrease. And I certainly hope that the Chinese are ready for that because there's going to be demographic pressure, there's going to be political issues that arise out of the slower growth. When you're growing, and just like a company, when you're profitable, people overlook a lot of stuff. And it seems easier to manage when you're profitable. But then the crisis happens. And then you really see the quality of the leadership. And often you realize the leadership is pretty weak at that point. So I think that China, it's a known situation. Your growth is going to decrease. You look at the demographics, again, it's highly forecastable what the demographic situation is going to be in China. So you got that information, so what are you going to do with it? Okay, so they need a risk management plan because they cannot expect to continue with this 9% growth. And I don't think that the trigger is necessarily a European crisis. Yes, it might come faster where China might go into a recession or a crisis. All these emerging markets have crises. So China could have one too. So maybe the crisis is triggered by a 2% growth rather than 9% growth. Could be relative. But there will be a disruption, and I think that China is a very important part of the world economy right now in that it's a lot of the growth engine. Okay, so it's got growth, and it's emerging markets provided an amazing hedge in the financial crisis. You look at, it's actually interesting, if you look at emerging market stock returns, it used to be that they were very uncorrelated with, or very low correlation with developed markets. Now it's like 0.9. But, and this is really important, that sort of correlation is an average correlation. So it could be some asymmetries. So things like, it might be that you do, as on the downside, you suffer about the same drawdown as developed markets, but when developed markets are doing really well, you do way better than developed markets. So you have to look at kind of asymmetry in the behavior. So, and that's essentially what we've seen. So we've seen, like the drawdowns look approximately similar, but when things are really okay in developed markets, emerging markets do really well. And I'm talking about a diversified portfolio of emerging markets. So I think that it's realistic. It is for people doing valuation work to extrapolate the growth rates that we've seen in China going forward. That's just not good valuation work. You need to be much more reasonable on that, and I do think that does cause some problem because people do have unrealistic expectations here. We need to expect some sort of slowdown or potentially a crisis.